Hi, and welcome back to AWM News Update. I am Dariush Yazdani, and as always, I'm joined by my co-anchor, Zoa Ahmed.
We have a jam-packed show today, Dariush, looking into issues such as whether MiFID II is benefiting active and passive funds, how ESG considerations are driving change in the AWM industry, and the effect of fee pressures on alternatives. Let's turn to the markets and what has been making news.
Today, we are looking at the end of Q2 data for the global industry. Globally, assets in regulated open-end funds rose by 6.7% to 45.65 trillion euros at the end of the second quarter. However, the picture looks different when looking at net sales. Long-term funds net sales fell in Q2, dropping from 491 billion euros in Q1 to 159 billion. Of this, inflows into bond funds accounted for 60 billion, equity 36 billion, and balance 23 billion euros. Inflows into money market funds increased from 11 billion euros in Q1 to 31 billion in Q2. Let's take a look now at what's happening around the globe.
In the last month, ESG issues have definitely risen in prominence. In the UK, the Financial Reporting Council is preparing to adapt the Stewardship Code. This would increase standards among UK-based managers. Stewardship experts in the country have called on asset managers to practice what they preach when it comes to governance. We are now joined by Abhilash Mudliar, Research Director at the Global Impact Investing Network, to discuss the rising popularity of impact investing, particularly amongst asset managers. Thank you for joining us, Abhilash. What would you say are some of the factors that are leading more asset managers to turn to impact investing?
Absolutely, that's a great place to start. So there are several factors behind the growth and the momentum in impact investing. The first is that there's this fundamental shift taking place with respect to the expectations of finance in society. People are increasingly of the view that the purpose of capital needs to be about something more than just generating more capital. Second, investors across the spectrum from, again, retail all the way to institutional want to align their values with their investment choices. Or another way to put this is they're asking the question, what is the world that I'm investing in? Another factor is evidence on performance. Increasingly, we're seeing that impact investments can generate returns in line with more conventional investments. And this makes impact investing a more viable and attractive opportunity for a wider range of investors.
What do you see in the coming years for impact investing?
So we see impact investing as both an industry, but also a movement, and a movement that's seeking to transform the ways in which people perceive the purpose of finance in society. And so increasingly in the future, not only will we see more and more investors engage in impact investing, but we also expect that the integration of impact will simply become normalized in investment decision making. So in the future, we think there'll be a time where it's simply unacceptable to invest with complete disregard for the impacts on people and planet, both because of changing social norms, but also because it just makes good business sense to take these factors into account.
Thank you for your insights, Abhilash. In terms of environmental, rising regulatory and investor demand is causing an increasing number of funds and asset managers to implement environmental considerations into their investments. Earlier this month, the Securities and Futures Commission launched a strategic framework calling for increased environmental disclosures from listed companies in Hong Kong, with a particular focus on climate and global warming risks. Now, let's turn to actives. Margin pressure is top of the agenda for many active asset managers. However, the efforts made to mitigate this pressure have led to a wide-scale decrease in product innovation, according to the CEO of Track Insight. Fund managers are having so much pressure on management fees, they barely have room to invest in any innovation. As a result, these managers risk damaging their business in the long term and losing out to ETFs. We are joined now by John Siciliano to chat about this point. John, thanks for joining us. Do you see the active asset management space becoming further threatened by passive players? And how do you believe managers should react to this competition?
Well, thank you very much for having me, and thank you for the question. I think when you look at what's going on in the passive marketplace, one needs to divide up the answer by geography. Certainly, in the context of the United States, we are going to continue to see passives grow significantly. At this point, our firm projects that we are going to see passive assets somewhere in the range of 40 to 45% in the United States and Canada by 2025. When you begin to look at Western Europe and Asia outside of Japan, I want to break that into two separate markets because Western Europe has already had an introduction into passives that we think will take further and greater hold in the years ahead. And when you look at Asia outside of Japan, you have economies that are emerging as saver economies. So these are folks who over the time, or we could really even say over history, have not really had savings cultures. And as we see these saving cultures evolve and develop, we think passives become very attractive. But in the aggregate globally, it's conceivable that we're going to see passives somewhere in the area of 25 to 30% globally by 2025, but broken out along the lines that I mentioned.
Some interesting points from John there on the future of active managers. What we've seen so far in 2018 is that actively managed funds sold cross-border have average monthly net flows of less than $1 billion compared to the average $15 billion in 2017. According to BlackRock, MiFID II is one of the driving reasons behind this, as advisors pause to accustom themselves with the new transparency regulations. However, that is not to say that MiFID II will have an exclusively negative impact on the industry.
Exactly, Zoa. Once managers adapt their operations to meet these new regulatory requirements, this greater transparency could open up new distribution possibilities. Now let's see what's been happening in passives.
After Fidelity's recent launch of 2 mutual funds with zero fees, Vanguard CEO announced that the fees of their funds would move closer to zero, but not reach it. It's likely that the move to lower fund fees will become all the more prevalent across passive fund ranges as MiFID II becomes more entrenched in the European fund industry.
Absolutely, Zoa. In August, European ETFs saw inflows of 2.3 billion euros. This is, however, only roughly half the amount of flows observed at the same time in 2017.
Exactly. It's likely that as advisors are required to explain all fees, the index fund industry will profit as low-cost products become increasingly attractive to investors. These products will also likely become more readily available as the industry digitalizes.
Let's turn to alternatives.
Research has found that newly emerging hedge funds must look to fee innovation and marketing efforts in order to increase capital. So far, emerging hedge fund managers, defined as those with less than $500 million under management, have been significantly less flexible on fee structures than their larger counterparts. The Alternative Investment Management Association has stated that these emerging managers must consider lowering their fees or risk losing investors.
This corroborates with the findings from the Asset Management Exchange study. The study concluded that fees are the main obstacle preventing investment in hedge funds. A lack of transparency regarding extra costs was also highlighted as a major barrier to investment.
In other news, there has been quite a lot of movement in the past month. BlackRock has received approval to establish an alternative investment management company in France. This marks the beginning of the firm's strategy to expand its influence into Europe. Apollo Global has taken over as fund manager of JP Morgan's $300 million realty fund in India. Let's move on to research reports.
PwC released its new report entitled Asset and Wealth Management Revolution: Pressure on Profitability. In the report, we forecast asset-weighted management fees falling by almost a fifth by 2025. John joins us again to discuss the report. John, in line with the report on pressure on profitability, estimating that the industry will feel sustained fee pressure up to 2025, How should managers react to this?
Well, I think you have to look at how the industry is evolving and the fact that managers with scale have a tremendous ability to succeed to even greater heights given that scale. And so they are able to do multi-asset products, they're able to make the technology investments, they're able to explore multiple channels of distribution. What that does is further heighten the difference between the very large firms and the medium-sized to small firms. The medium-sized to smaller firms need to focus on ways that they can bring distinctive value into the marketplace. And that means such things as continued investment excellence, rationalization of products, focusing on being a sleeve in a multi-asset or target date product, or focusing on providing some form of sub-advisory service. What we really are in right now is an era where you're going to see continued division between the big and the small, and the definition for small has become bigger. And you're also going to see a continued pressure around investing in the industry, which goes against the pressures around fee declines and industry consolidation.
And John, do you believe the industry will grow in the coming years? And what are the challenges and opportunities of this growth?
The industry is definitely going to grow in the coming years. As a firm, we believe that it will grow from approximately 105 trillion in 2020 to approximately 145 trillion by 2025. And this growth is going to come to some degree from the traditional markets of North America and Western Europe. But in fact, those growth rates are going to be mid to high single digits. Where the real growth is going to occur, X market appreciation, is going to be in Asia outside of Japan and in Central and South America, because what we're seeing in those cultures is a tremendous emphasis on savings as these cultures emerge from being, let's call it, less economically successful to more middle class in nature. And as they become more middle class, a savings class develops and then an investor class. And we think that investor class is going to have a significant impact in terms of overall market size growth. In addition, when you look at what's going on in the sovereign wealth space, you're going to see a tremendous amount of activity as sovereign wealth funds continue to grow and they continue to focus on multi-asset investments. And then finally, with the whole retirement shift from the institutional defined benefit to retail defined contribution, all global markets will experience significant growth. We think anywhere from low teens to high teens, depending upon the specific geography, as retail retirement becomes the standard.
Some useful insights from John regarding the possible challenges that managers will face, but also how they can make the most of possible consolidation in the industry. That's all the time we have for this month. Thanks for joining us. Please remember to subscribe and share, and we will see you next time.